Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's April 13th, 2023. We got a great guest for you. A gentleman I met, we realized it was over 10 years ago. Jim Iuorio. He is not only the managing director of TJM Institutional Services, he's also the host of the Future's Edge podcast. Jim has been in the market for several decades, well respected. You'll see him on national television all the time being interviewed. Lucky enough to get him as a guest. And we're going to dive into everything from the Fed to the U.S. dollar to really what's going on right now with the U.S. economy. Does Jim believe we're going into recession? And then some of his favorite investment areas right now. You'll be surprised. We talk about gold, we talk about silver, copper, even Bitcoin. And of course, Jim's island investment, the one he likes for the next 10 years. This is one nobody's ever said on the show before. You want to tune in and find that out. Coming up right now on Making Money. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. All right, so without further ado, here he is, Jim Iuorio. Jim, thanks so much for making your first appearance here and Making Money. I mean, I think we crossed paths for the first time, over a decade ago, maybe? Quite a mutual friend.
Easily, quite a bit. It shows how old we both are. And I think it was probably even more than a decade ago, right?
I know, it's pretty crazy. I remember, I think it was Scott who introduced us, and I used to work out with Scott when I lived in Chicago. I'm like, that seems like 2 lifetimes ago. It's crazy.
Doesn't it? It's crazy how
we're still doing it, though.
Goes.
We're still doing the same thing, Jim. It's
no
crazy.
doubt. Does Scott still work? He worked for Ken Griffin, right?
Yeah. I'm not quite sure where he's at now. I think he's doing something. But I will tell you this, and nothing at Scotty Markets, but I saw him the other day, and I had to send him a text. He was on TV. I said, boy, oh boy, you got gray, buddy. And he's younger than me, and he didn't like that, but I had to go at him when I saw him on TV, and I was in an airport, and I sent him a quick text. But awesome. So good to have you on. Thanks for coming on, and of course, you're the host of a podcast as well, the Future's Edge. So everybody, please check that out as well. Let's just jump into it, Jim. We've had a lot of economic numbers kind of come both ways recently. We had the JOLTS number, the job openings number, came out, and that was much lower than expected. We had some major disappointments in both the ADP and ISM numbers. How are you viewing right now the economy based on the most recent numbers?
I think it's all happening. I think that things are deteriorating for people like me who have predicted, I guess you'd call it, a recession for the last 4 months. It's all happening right now, which, by the way, that's no sort of genius prediction. I mean, the Fed tells you basically they're going to destroy the demand and bring it down to, at the very least, recessionary levels. It's not like I'm some guru saying that there's a recession coming. That's what I believe for 4 months, and I believe we're coming to it now. Tomorrow we have the NFP numbers, which I think that'll be a confirmation of things slowing in labor. And remember, labor was like the last shoe to drop. Those ISM numbers, I think you mentioned too, the new orders component of it was the weakest part of it, and that's the most forward-looking. So I think we're starting to see the inflation's coming down, and right now we're actually starting to see the effects of the rate hikes. All of us know that rate hikes don't affect immediately. There's obviously a lag time. And right now, as the economy's slowing down, we're going to get the punch from that. And you see the Fed futures curve says that there's going to be 200 basis points of easing by the end of 2024. So the futures market is saying that the Fed is definitely over their skis.
So let me ask you this, going into Fed, I mean, I think people love to hate the Fed and bash the Fed, and it's a tough job. I wouldn't want it. But when I look at the Fed, you mentioned a point that I think a lot of people ignored was the fact that rate hikes take time. It's not like you just you raise interest rates and inflation comes down. There's a lagging timeline in there. Do you think the Fed went too much too fast? Do you think they went too quickly and they should have given it time to really slow down on its own?
Absolutely. I think when the yield curve inverted, that was telling us immediately that the Fed was either going too far or absolutely had to go too far. And it's based on the lag time you just mentioned. They have these very blunt instruments to tackle a very, very intricate problem, and they cannot possibly work. That's why the Fed always goes too loose for too long and then too tight for too long. And it's always playing this game as they're pushing the pendulum back and forth. It's really frustrating. You said, it's a tough job. I wouldn't want it. And I agree. But that doesn't mean we can't call them onto the carpet for absolutely missing this in June of 2021 when the CPI had already printed over 5%. The housing market was parabolic, and they still continued to accommodate, and they bought 250 just of mortgage-backed bonds in the wake of that. I think that there was a huge mistake. That's what caused the stickiness of the inflation, and that's what made it stick around as long as it has. And now they're going to go the other way, which I think is sad and frustrating. But again, as market guys, we just have to figure out how to negotiate that.
Yeah, exactly. I mean, I think obviously, recession to me was priced in, and quite a bit. In a lot of these stocks had been priced in, and doesn't mean stocks can't go lower from here. I'm not saying that, but I just see, I see some bargains, but I still see a lot of stocks that are overpriced, Jim, too. Like it's tough to talk about valuation in the market to me because it's bifurcated. I think you really have to look more at individual stocks. So you believe a recession's coming. You believe that the Fed will, and the market's saying that will obviously lower rates quite a bit in the next almost 24 months, 21 months or so. What do you see the market reaction to all this?
So I think, and I gave a speech at the New Orleans Investment Conference in October, and I was probably a little ahead of it, but I liked copper, gold, silver. I didn't say Bitcoin, but now I'm adding that in now. And again, hindsight is obviously 2020. But to me, it's that the Fed is now, the market is saying the Fed is going to start pumping money back into the system. But the corporate sector, the run-of-the-mill companies, the ones you talked about, regular valuation companies that are starting to report earnings next week, those companies are the very things that the Fed has damaged, has punched. And so I think there's going to be some money escaping in to metals, and the copper trade is a little bit different too because that involves China, it involves decarbonization. But gold and silver are the most pure plays of the Fed all of a sudden pulling the lever for money coming back in, but the corporate sector not being quite ready yet. That being said, you said the market stock can go lower from here, and I agree 100%, but it's been already 15 months of a sideways negative trade. You and I both know that these corrections in bear markets happen in price and in time. That's a lot of time so far, and I don't believe there's these massive leveraged, built-up positions that have no respect for risk that generally precedes these 30% drops when the stocks really get hit. I don't think that's there. Could I see another leg down? Sure. I think 3,800 it was my target before, and I still can't decide. We traded down to about 3,850 2 weeks ago, and I can't decide if that fills my technical picture. I wouldn't mind seeing it go down that way again, but I don't think the bottom drops out of this.
So do you think that October low down around 3,500, do you think that's going to hold for now?
I believe that's going to hold because my next level after 38, if that gives, was 36, and I believe those hold. I think to go through there, something would have to materially change, whereas we would be obviously in a recession and the Fed still would have some sort of ridiculous mandate in their head that they still had to keep fighting a foe that they've already defeated in inflation. And I think that it would involve some really a high level of stupidity to push us below that because I don't think there's the leverage positions.
You never know. The stupidity level is pretty damn high in DC these days, so you never know what the hell can happen over there. I can't remember who it was. Was it Bullard or Meester? One of the Fed presidents came out recently and said basically we need another 75 basis points to the upside for Fed funds rate, where the market's pricing in 25. I mean, am I just missing something? I just don't understand where that's coming from.
So I think there's two things. I think one is that they have to talk tough right up until the point that they can't talk tough anymore. That's part of the whole procedure is that you can't start letting your guard down while they're still in the fight. Secondly, in Mike Tyson's word, everyone has a plan until they get punched in the face. When things start to really deteriorate, and we saw this, I think it was Loretta Mester who you were quoting, but back to James Bullard, it was August and maybe at least 10 years ago, but they were about to embark on a tightening cycle and they tightened once And James Bullard came out saying the case for tightening is strong. The next day, the stock market cratered 8%. He gave a new speech saying the case for tightening has lessened, meaning to me that only thing that lessened was the 8% of the stock market, and they panicked. They panicked in the past, and now we knew that the Fed put was not what it was before. We knew they were going to let the stock market have a correction, but my contention is they have. And the Fed put never went away, just the strike went down a lot lower, in my opinion, if that makes sense.
Oh, that makes perfect sense. I saw a chart the other day. Since '83, I think it was. There's been 5 situations where the Fed had a tightening cycle, and after it stopped, when it paused, the 3-month and 12-month return after. I think the 12-month return was up 4 out of 5 times, an average of, I'm going to say 19 and change, 19.5%. Do you see the pause, whether it be May or June, as an opportunity for stocks to move up? Do you think it's going to follow that historical pattern?
That's my belief. Now, I need technical confirmation of that. I want the S&P to settle, the futures I'm looking at, to settle above 4250. Maybe
Okay.
give me a day, give me a week settlement in the coming weeks, and then I'll be a little more emboldened to the long side. So I think that's the case. I think that the stock market, again, you talked about individual companies and valuations, and I think that's wonderful. And I wish that that was the primary thing. I do think that correlations exist because of Fed intervention that's gone on for 13 years for sure, 30 years probably, that things move in tandem. Larry Kudlow, I'm not above name dropping, but Larry Kudlow and I have had a running joke for 20 years where he says profits are the mother's milk of stocks, and I say no, Fed intervention is the mother's milk of stocks. And I hate that exists. I think it's the wrong way. But again, as a technician and as a trader, you just deal with the cards you're played, to use another metaphor. So I think that the Fed is the most important game in town.
Yeah, I mean, what's the other one? Don't fight the Fed. I mean, really, it's you wish it was based on pure profits, right? And
Mm-hmm.
the way that the stocks should be valued. But you're right, and I love that you brought up the fact, Jim, is you play the dealt, the hands that you're dealt, and that's true. There's too many investors and traders out there, and individual people doing it that have like the kind of this that the blinders on, right? They're like,
Mm-hmm.
this is what I read. This is what I'm going to do. You're going to get crushed
Yeah.
because you have to adapt to the market and let the market tell you. I mean, you can't tell the market what to do because I've tried that in the past. I've been in this business a long time. I learned the hard way, right? You
Yeah.
learn, okay, whatever mother market tells me to do, that's what I'm doing.
And to put a finer
So,
point on that too, we could sit back. Like, I love saying what I think the Fed should do, but that's just a hobby of mine. What the Fed is going to do is much more important for my real job, was to try and capitalize on that.
so let me ask you that. What should the Fed do at its next meeting?
The Fed should do nothing at the next meeting.
No.
The Fed
Okay.
should have done nothing at the last meeting, in my opinion. Like we started this with, like, let's just say, some economists say that there's almost up to a 20-month lag period before we feel the efficacy of these rate hikes. Let's just say in the modern world of technology, everything is quicker, and that has gone down to 6 months. We're
Mhm.
still only, we're a year into it. So we're just starting to feel the effects of the first few tightenings right now. Just ask yourself this: is there a neutral rate? Now, you've looked at, John Taylor has the Taylor rule, and the Taylor rule would have had us hiking the Fed funds rate up to 6%, several months ago, several quarters ago. Is the relationship that existed between low rates and the corporate sector as a whole the same as it was 50 years ago? Of course not. Our government over the last 30 years sees companies making money. They tax more, they put in more onerous regulation. The Fed lowers rates to keep things going. They see them making more money. The federal government increases taxes, increases more onerous regulation. The Fed lowers rates again. And again, this isn't even my opinion. You look at rates going back to the 80s, all they do is
Mhm.
try to go up a little, go down, try to go up a little, go down. So right now, to think that we could put the Fed funds rate at 6% and there's not going to be something breaking all over the economy, I think is
Mhm.
absolute folly, and I think it will.
Yeah, I have to agree with you. I mean, it's another world. We can't compare it to back then.
No.
We're truly in another world right now. What is your view then on the U.S. dollar? Because obviously we had a hell of a run last year. We're about 11% or so from that peak that we hit. And obviously, the reason I'm bringing this up is you talked about gold, silver, copper. Gold over time typically has a bit of an inverse relationship to the U.S. dollar. So if you're bullish on those commodities, those metals, Jim, do you think the dollar then will continue to fall?
I do. Now, I'm not one of these, the dollar is going to lose its hegemony and lose its reserve status.
Mhm.
I'm talking about this just as the Fed moving from hiking to either neutral or easing. and the dollar coming off in response. And that's why those things could do very, very well. Yeah, and it's a very astute observation. If I like all those things, I have to be at least a medium term bear on the dollar, and I am. And I think it comes from the fact that the Fed is overdoing it.
It's funny you brought up that, you're not thinking that the death of the dollar is on the horizon, because you probably get the questions I get when people see you in public and stuff, and they always bring up crazy shit. It's like, oh my God, I read this article that they're going to raid the banks and the dollar's done and all this stuff. So I had to start getting some facts to kind of prove people and not just say you're crazy. And I saw recently that percent of foreign currency, the US dollar, I think in 2000 was 70%, and now it's down to, I want to say 59, 61, something like that. So it has declined. But then it listed, Jim, it had the euro, I think, was at like 24%, if I'm not mistaken. The Japanese yen was 6%, and the Chinese yuan was 2%. So I'm same as you. I don't see anything on the horizon in the near term that's going to take away the dollar. It's just not going to happen. But, you read on Twitter, oh my God, they just made their first deal, Saudi Arabia and Russia and Chinese yuan. Holy shit, this is the world's falling apart. Like, it's okay, big deal. That's one transaction. This isn't, you can't just change it over.
And
And yes, will our empire that we call America fail at some point and be done? Yeah, history proves that, right? I just don't think we're there yet. So I'm glad to hear somebody I respect say that, because it's just sometimes you start hearing craziness and you almost want to believe it, Jim.
oh, no doubt about it. And I'll add this to you. And I wrote this and put it out on Twitter last week, is that you don't have to have a great currency. You don't have to have a good currency. You just have to have the best currency. We certainly do now. And by the way, the thing that really irritates me quite a bit with when you look at the stewardship of our currency is that we have this wonderful spot, and I think it has created some just wild irresponsibility. Like when you think about those idiots who were pushing the modern monetary theory thing over the last few years, like talk about just idiotic theoretical platform. That we can just print as much as we want, and then immediately when we start to see inflation, you raise taxes to pull liquidity out of the system.
Yeah.
Well, the politicians aren't that smart to even notice inflation. They didn't notice inflation in tech stocks. They didn't notice inflation in the housing markets. So if it's non-traditional inflation, they can't figure it out. The one time we did see it a year and a half ago, they told us it was transitory. Plus, and the thing that makes it even a more moronic system is the notion that where you are in an electoral cycle, you just raise taxes really quickly and start to feel the effect of that. Like, it falls apart in everything you see. If your election's in a month, you're not going to be raising taxes on your constituents. So if you want to elect politicians for life, maybe they'll have the latitude to do that, but I don't want to do that.
No, I think the opposite. I think we need term limits.
Amen.
Yeah, are you kidding me? That's the last thing I want to hear. I was like, give me the chills there for a second.
Yeah, exactly.
Let's go back to gold and silver, because it's interesting, because I have had a lot of guests on recently that have been bullish on gold, and more than I've heard as of late. Obviously, breaking above $2,000 an ounce, I think maybe brings a little bit more attention to it. But I get bashed for a lot of things in social media. The number one thing I get bashed for is that I've never been a gold bug. I'm just not a big fan of gold. I when I managed money years ago, I held it in the early 2000s to, like, I'm gonna say 2010, 11, somewhere in that weird time frame. And it was a large holding for our clients. But since then, I don't have exposure to it. And they think I'm a lunatic because, I believe in a lot of things you believe in. And if I did, I should probably own gold. Obviously, you talked about some reasons you like gold. Is that something that you consider a true asset class for most people to hold forever? Or is it something you use the charts and you're trading to get in and out?
I use charts, and those charts could sometime give me a long-term opinion on gold. So I plan on having this position on for a long time, and it's not some you've known traders, and when you start losing on a trade, all of a sudden you pop it into your investment account. It's like what the banks did with their treasuries. No, this is a hold to maturity. It's fine. We don't have to worry about it. And I'm not doing that. I'm putting this on with the intent of keeping it for a long time, and it's part of a whole portfolio that includes silver, copper, Bitcoin, platinum. And I call it my poor stewardship of the U.S. currency and currencies in general hedge account. So if I want to be wrong, essentially, because I don't want them to do anything to screw up the U.S. dollar. We talked about before about the dollar not losing its hegemony, and I don't think it will. But I think the chance of that happening has gone from 0.001% to 2%. I mean, I still don't think it's going to happen, but I think there has been some playing fast and loose with our currency. So yes, I plan on keeping gold for a long time. And I guess ultimately, I don't mind if I lose money on it, because that'll make the assumption that I'm making money on a lot of other things
Yeah.
because they haven't done something ridiculously stupid with the dollar and driven it into the ground.
That makes perfect sense. How about the copper play? Obviously copper could be driven more by the economy, and China continues to reopen. Obviously, big demand from the second largest economy in the world. How did you come to that, or is that all part of this as well?
No, so the copper trade has different nuances to it because copper. The reason I was putting it on in the first place, and this goes back to October, was the China reopening after their unbelievable COVID lockdowns, plus the decarbonization thing. So the China reopening has gone very, very rocky, and copper has still gone higher. Copper supplies are tight. We are operating at a deficit right now, and according to the Goldman Metals desk, if things go the way we think they're going as far as the green revolution, whatever we call it, the decarbonization, the copper is going to be needed quite a bit. So like I said, we're already at like a 4 million metric ton deficit per year, and that could go up as high as 10 million. So even if the global economy slows down, my hope was that the transformation to decarbonization still gives some support of it during that time. And then when global economy starts to take off again, particularly China, the copper really runs. Now, there's something I'd like to add too, is that you and I have both been trading markets a long time. The copper market is very, very sensitive to China. Whether or not that's reasonable anymore, whether or not the numbers as far as production and consumption coming out of China doesn't matter anymore. The market believes that if China starts on a good path and a good momentum in a GDP way and an economic way, that copper will rally. You don't fight it. You just get it. You get involved. You get involved in copper, and you don't worry about what the actual story is regarding consumption. I know that doesn't make sense to a lot of people, but we see this kind of thing happen quite a bit.
So, I personally like copper, and I'm probably similar to you. We were talking off air about kind of our views on fossil fuels and stuff and clean energy. And I'll be honest with you, I was wrong on the oil trade the last year and a half. I missed a lot of it. I missed a lot of the upside, and we had some exposure to solar stocks that actually did pretty well last year in the face of kind of a rough year for overall stocks. But we've recently created what we could, the barbell, the dirty energy over here and the clean energy over here. And for the clean energy to work, I'm trying to find the graph here while you're talking. I couldn't find it, but the amount of copper needed to meet any of these goals by 2050, and this is what your trade is based on.
Metric shit ton.
It's insane. It's actually it's a metric shit ton. It's so much copper. It's nuts to me that where are we going to get it? The price has to go higher. So how would you invest this then, Jim? Would you buy copper futures? Would you look at ETFs? Would you look at copper related stocks?
Okay, so the CME has copper futures. They have micro, but you have to roll those. Now, I've been told by my attorneys over time again, because of my licensing in the futures market, I can't talk about specific names, but the miners are interesting. And there's that one miner that I won't mention the name of, and you probably can if you want, that tracks copper prices very, very closely because that's what they produce. I think they're 60% copper, 40% gold, or some sort of ratio like that. The big one. And I have that, and I look to trade the copper futures.
Okay. That makes sense. And you'll just roll those out then, the copper futures?
You have to, so that's a problem with having futures on. The good part is capital preservation, where you can move a lot of copper with just a little bit of margin money. But the bad news is that you have to roll them every 3 months. So that's futures are great, and I'm a devotee, but there are some downsides as well.
Yeah, I won't mention names. I don't want you to get in trouble, but I think most people listening, watching the show,
they know what I'm talking about.
No,
they're not recommending anything.
They know what it is,
and I don't recommend anything to anyone. I tell people what I'm doing, what I'm looking at.
This entire show, I always say in the beginning and nothing here is a recommendation, buy or sell. Do your own homework. Yeah. We're here for 3 things, Jim. We're here to educate you, have fun, and hopefully make some money.
Good.
That's the 3 things we're looking to do.
Yeah.
Jim, before we wrap the show, I ask every single guest. You don't have to answer it, but I will say everybody else has answered it so far. And I know you can't name individual names, but if I sent you away, I call it the island question, to an island for 10 years, family, friends, whoever you want to take, maybe you want to go by yourself. Who the hell knows? Get away for 10 years. What's the one investment, and it could be an investment class and anything. I know you can't mention individual stocks. What's the one investment you feel kind of secure holding for the next 10 years without looking at it?
Yep, I will definitely say the metals, copper specifically, because of the reasons we talked about. And the reason I wouldn't say, different sectors of the equity market too, is I have a serious worry about the cost push inflation, and the government now at times it seems like they almost want to fuel this inflation trade, which may keep, and I know I've said quite clearly that I think rates are coming down, but I do have the worry when you look at worst case scenario is that the inflation stays strong because of what the government's doing, and the Fed then keeps rates inorganically high after 3 decades of inorganically low, and that could affect the non metals market like that. And I think that copper would be the number one thing from the decarbonization and what we talked about.
I'm going to ask you, how do you think Bitcoin? You view that long term, or are you more
I
of a
do.
trader of that?
No, and
Okay.
it's funny because I have Bitcoin and I don't trade Bitcoin, but I buy it every Wednesday. I have for about 6 years,
Wow.
and I have a regular scheduled purchase of it. And before I even really understood it, I believed that what they were saying is that these fiat currencies are being treated badly all over the world. At some point in time, we might need a payment system and a transfer system that's not fiat currency related. I held off a long, long time because I just assumed governments would put a stop to it. And then I realized when governments try to put a stop to it, oftentimes it just fuels the fervor. So I do have Bitcoin, and it's slowly becoming a fairly major position of mine. And that's based on someone who doesn't know a ton. I think all the punches that cryptocurrencies have taken over the last year, and
Yeah.
even just in November, Bitcoin was like 36% of the total crypto market cap, and now it's as much as 47%. So it's like this flight to quality that's happening within crypto that's pushing things to Bitcoin. The new system upgrade in Ethereum, that the Shanghai hard fork that's coming in the next couple of weeks, has made Ethereum seem relatively attractive to me as well. So those are the two that I hold. It is against part of that portfolio where I hope I'm never really 100% right on this, because that will mean the dollar is absolutely getting the crap kicked out of it, and I'm not comfortable with that.
No, that's great. I love how you mentioned every Wednesday buying it, because I saw an article last week that said if you started buying Bitcoin at the height, 69,000 per token, and you dollar cost average, you'd actually be up right now.
Right.
People don't get that sometimes,
Exactly.
right?
Yeah.
Because I don't know where it's going to go day to day, month to month, even year to year. It's so damn volatile.
Yep.
But I believe in it long term, and I'm the same as you. I should start doing it on more set times, but I do periodic buys throughout. When it dips, I buy it, and
Yeah.
then instead of panicking, selling like majority of people do, and
Right.
that's why they struggle to make money. But I got to tell you, Jim, I'm happy now because I'm going to head into the weekend here and feel good because, again, high respect for you, and we're actually on the same page. So
Cool.
that makes me like, whew, I might actually know what I'm doing here 25 years later after doing this shit. So,
I
but hey,
appreciate
man,
that.
thank you so much for coming on. It's been a pleasure, and hopefully we'll get you back on soon.
Thanks, Matt. I enjoyed it. See ya.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.